I need you to stop whatever you're doing right now and pay very close attention to what I'm about to explain, because what unfolded in the silver market during the past 72 hours isn't just another rally. It's not simply another breakout. This represents a structural fracture. This is the precise moment when decades of artificial price manipulation finally crashed into the immovable wall of physical reality. And that sound you're hearing right now, that cracking, splintering noise reverberating through the global financial system, that's the connection between the paper market and the physical market finally breaking apart. I want you to look at your screen right now. Silver is currently trading at $84.15 per ounce. Gold is sitting at $4,529.30. Now, to most people watching financial news this evening, those are simply numbers. They see a metal rising, they notice a percentage gain, and they continue with their day. But if you comprehend what's actually unfolding beneath the surface, if you understand the forces converging at this exact moment in history, you realize we are not observing a bull market. We are witnessing a reckoning. We are watching the endgame of a 40-year suppression scheme that is now being overwhelmed by forces too powerful to control. Today, I'm going to walk you through exactly what transpired. I'm going to show you the technical breakout that proves the old resistance levels are dead. I'm going to show you the global arbitrage failure between New York and Shanghai that is creating an irresistible magnetic pull, dragging Western prices higher. I'm going to show you the physical supply crisis that has already caused the street price in America to disconnect from the screen price. And most importantly, I'm going to show you why the moment we're in right now, January 12th, 2026, is the inflection point separating the before times from what comes next. Because once you cross this threshold, there is no return. The game has transformed, and the people who understand that are positioning themselves on the right side of the greatest wealth transfer in modern history. Let me start with the chart, because if you know how to read the technical language of market structure, the chart is screaming at you right now. It's communicating in plain, undeniable terms that we have entered a new regime. For those of you who have been following this market, you know that silver has spent decades trapped inside a massive consolidation pattern. Every time it attempted to break out, every time it approached those old highs from 2011, it got smashed back down. The commercials would dump thousands of contracts into the futures market. The algorithms would trigger cascading stop losses, and retail traders, terrified and demoralized, would sell at the worst possible moment. This cycle repeated endlessly for 15 years, until now. On January 9th, we witnessed what the textbooks call a bear trap. The price got hammered down to $74. It was violent. It was sudden. And it was engineered to accomplish two objectives. First, flush out the weak hands, trigger every stop-loss order sitting just below the support zone, force over-leveraged retail traders to liquidate their positions at a loss. Second, lure in fresh short sellers, make them believe the rally was finished, make them think they could ride the price back down to $65 or $60, convince them this was just another failed breakout attempt. And it worked perfectly. The shorts piled in. They sold contracts at $74. They sold more at $75. They thought they were geniuses. They thought they were entering at the top. They had absolutely no idea they were about to get annihilated, because Sunday night, everything changed. The market opened with an immediate gap from $80 to $82. Now, let me explain what a gap means in technical terms. A gap is a price range where no trading occurs. It means that when the market opened, there were so many buyers and so few sellers that the price had to jump over an entire $2 range just to find the first person willing to sell. That is not normal. That is not a healthy market. That is a market that is panicking. That is a market where the buyers are no longer negotiating. They are simply hitting the buy button at any available price because they are terrified of being left behind. And then, throughout the overnight session, we saw what I call the staircase pattern. Sharp vertical moves followed by brief consolidation. Sharp vertical moves followed by brief consolidation, over and over again. This is not retail buying. Retail buying is erratic. It's emotional. It spikes and crashes. The staircase pattern is the signature of institutional accumulation. It's the signature of sovereign wealth funds. It's the signature of entities with billions of dollars who are methodically absorbing every single ounce offered for sale. They are patient. They are disciplined. And they are building positions they have no intention of selling anytime soon. But the real fireworks started at 8 a.m. New York time, when the algorithms in Manhattan woke up and registered the price sitting at $83. They looked at the price in Shanghai and realized there was a massive arbitrage opportunity. And that's when patience ran out. That's when the panic chase began. Volume exploded. The price tore through $84 like it wasn't even there. It kept climbing. 85, 85.20, 85.37. And here's the most important technical detail. The final 30-minute candle of that move closed at its absolute high. There was no upper wick. In technical language, That means zero selling pressure. It means the buyers were so desperate that they bought every single ounce offered all the way up to the top. Nobody was taking profits. Nobody was scaling out. Everyone was holding. Now, let's talk about the $85 level, because this is not just another number on the chart. This is the pain threshold. This is the level where the commercial shorts, the entities that have been suppressing this market for years, stop losing money and start losing solvency. Every single trader, every single bank that sold silver short at $74 is now underwater by $11 per ounce. Multiply that by the size of their positions, and you're talking about catastrophic losses. Losses that threaten their existence. And that means they are no longer fighting to protect profits. They are fighting to survive, which is why we are seeing desperate attempts to push the price back down. They are trying to engineer a backtest of the breakout. They want to shake out weak longs. They want to trigger another round of stop losses. But here's the problem. The physical market doesn't care about their technical games anymore. The physical market has decoupled. Let me take you to Shanghai. Because while everyone in the West is focused on what's happening in New York, the real story is playing out in the East. And what's happening in Shanghai right now is nothing short of a complete breakdown of the global pricing mechanism. For decades, the world operated on the assumption that silver was a fungible global commodity. That meant an ounce of silver in New York should trade at roughly the same price as an ounce of silver in Shanghai. If there was ever a meaningful gap, arbitrage traders would step in, buy the cheap metal, ship it to the expensive market, and pocket the difference. That arbitrage mechanism is what kept global prices aligned. It was the glue holding the system together. That glue is gone. The mechanism is broken, and the proof is staring us in the face right now. As of this moment, silver in New York is trading at $84.15. Silver in Shanghai is trading at $93.31. That's a spread of $9.16. $9 on a commodity that should be trading at parity. Do you understand what that means? It means that if you could buy silver in New York and sell it in Shanghai, you would make a $9 risk-free profit on every single ounce. That is free money. That is the easiest trade in the world. And yet, nobody is doing it. Why? Because they can't. The inventory doesn't exist. The metal isn't there. The COMEX vaults have been bled dry. The registered silver, the silver that's actually available for delivery, is sitting at historic lows. There simply aren't enough 1,000-ounce bars in London and New York to satisfy the demand required to close that $9 gap. And even if the metal was available, there's another problem. China implemented a new export licensing system that went live on January 1st. It's a one-way valve. Metal can flow into China, but it cannot flow back out. This wasn't an accident. This wasn't a bureaucratic oversight. This was a deliberate strategic decision by Beijing to trap physical silver inside their borders, to ensure that once the metal enters China, it stays there, to weaponize the supply chain, to turn silver into a strategic resource that they control. So the arbitrage trade, the trade that used to keep global prices aligned, is dead. The bridge between East and West has been severed. And the result is that we now have two separate markets operating at two completely different price levels. For decades, China was a price taker. They accepted whatever price was set by the paper markets in London and New York. They had no choice. They needed the metal for their factories. They needed it for their solar panels. They needed it for their batteries. So they paid what they were told to pay. But today, China is the price maker. Today, Shanghai is setting the price, and New York is scrambling to catch up. The shift happened because of three forces that are all converging simultaneously. First, inelastic industrial demand. China dominates global manufacturing. They produce more solar panels than the rest of the world combined. They produce more batteries than the rest of the world combined. And all of that production requires silver. It's not optional. You cannot build a solar panel without silver. You cannot build a battery without silver. And Chinese manufacturers have shifted their entire inventory strategy. They used to operate on just-in-time logistics. Order the metal when you need it. Keep inventory lean. Minimize costs. But after the supply chain chaos of recent years, they've switched to just-in-case hoarding. They are stockpiling raw materials to ensure their assembly lines never stop. Because if their factories shut down because they don't have silver, the economic and political consequences are catastrophic. So they buy at any price. They don't care if it costs $90 or $100. They just need the ounces. This creates an unbreakable floor under the physical price. Second, currency defense. The Chinese yuan is weakening. The Chinese property market is collapsing. Chinese citizens are losing faith in their domestic financial system. And with strict capital controls preventing them from buying dollars, they're turning to the only assets they can access, gold and silver. This internal monetary demand is adding another layer of buying pressure on top of industrial demand. It's not just factories buying silver. It's millions of individual Chinese citizens trying to protect their savings from currency debasement. This is a flight to safety happening inside the world's second largest economy. and it's pushing the Shanghai price higher every single day. Third, resource nationalism. We are entering a new era of geopolitical competition, an era where critical resources are being weaponized, an era where supply chains are being fragmented along political lines. China knows that whoever controls the physical supply of strategic materials controls the future of technology and manufacturing. So they are hoarding not just silver, but copper, lithium, rare earths. They are building strategic reserves. They are ensuring that if there is ever a full decoupling between East and West, they have the raw materials to sustain their industrial base while their competitors are left scrambling. This is not economics, this is warfare. Economic warfare. And silver is one of the primary battlefields. Now, let's bring this back to America. Because while the COMEX price is struggling to catch up to the Shanghai price, the physical street price for silver in the United States has already converged. Let me show you the mathematics. The COMEX spot price right now is $84.15. But if you go to any online bullion dealer and try to buy a silver eagle or silver maple leaf, you're not paying $84. You're paying the spot price plus the premium. And premiums have exploded. The average premium on a standard silver coin right now is $9 per ounce. So let's do the calculation. $84 plus $9 equals $93. The all-in cost for physical silver in America is $93 per ounce. That's the same price as Shanghai. The physical markets have already converged. The screen price is a lie. The receipt from your dealer is the truth. And it gets worse, because it's not just about price anymore, it's about availability. I've been in contact with sources at major private mints, the companies that convert those big 1,000-ounce industrial bars into the coins and rounds that investors buy. And they are telling me that delivery times have stretched to 8 weeks. 8 weeks? That's not a shipping delay. That's a manufacturing failure. It means the mints cannot source the raw 1,000-ounce bars they need to produce the coins. They are effectively selling you a promise. They're taking your money today and hoping they can find the metal to fulfill your order 2 months from now. That is a physical default happening at the retail level right now. The inventory buffer between the wholesale market and the retail market has been completely exhausted. I spoke with a senior executive at one of the largest bullion dealers in the United States, and when I asked him about inventory, his response was 3 words: nobody has any silver. He went on to say that if buying continues at the current pace, premiums could easily hit $20 or $30 per ounce. Think about what that means. Even if the COMEX price got manipulated back down to $70, if the premium is $50, you're still paying $120 per ounce for physical metal. You cannot print silver. You cannot short sell a silver eagle into existence. The fraud of the paper price discovery system is being exposed in real time. And the investors who understand this are not waiting for the COMEX to catch up. They are buying physical metal at whatever price they can get it, because they know that availability is disappearing faster than prices are rising. But let's zoom out even further, because to truly understand where this is going, we need to stop measuring silver in dollars and start measuring it in terms of its historical monetary relationship to gold. Because in a world where currencies are collapsing, using dollars as a measuring stick is like using a rubber band as a ruler. It's useless. The number keeps changing, not because the asset is moving, but because the denominator is collapsing. So let's look at the gold to silver ratio. For thousands of years, the natural and monetary ratio between gold and silver was approximately 15-1. That ratio reflected the relative abundance of these metals in the Earth's crust. It reflected their use as money. It reflected economic reality. But in the modern era, that ratio was distorted. At times, it exceeded 100-1. Silver was artificially suppressed and priced as just another industrial commodity, while gold retained its monetary premium. That era is ending. Right now, gold is trading at $4,599 per ounce. Silver is trading at $84.115. So the current ratio is 4,599 divided by 84.15, which equals approximately 54-1. If silver were to revert to its historical monetary ratio of 15-1, what would the price be? 4,599 divided by 15 equals $306.60 per ounce. At $84, silver is not expensive. It is trading at a 73% discount to its fair value relative to gold. This is one of the most significant catch-up trades in modern financial history, and it is happening right now. The psychological milestone that everyone is watching is $100. That is the number that will trigger a global media frenzy. When silver crosses triple digits, it becomes a headline story on every major network. It draws in public attention. It draws in capital from investors who have never even considered silver before. The fear of missing out becomes overwhelming, and that wave of new buying accelerates the move even higher. We saw this in 2011 when silver hit $50. The media coverage exploded. Everyone wanted in. The problem was the fundamentals back then were weak. It was a speculative bubble driven by momentum. This time is different. This time, the fundamentals are rock solid. The physical shortage is real. The arbitrage breakdown is real. The industrial demand is real. The currency collapse is real. When silver crosses $100 this time, it's not the top. It's just the beginning. Now, I need to talk about the Federal Reserve, because the precious metal surge is creating a systemic crisis that has trapped the central bank in an impossible situation. The entire global financial system is built on the assumption that U.S. Treasury bonds are the risk-free asset. Treasuries are used to value every other asset class. They are the foundation of the entire pyramid. And the parabolic rise in gold and silver is shattering that foundation. Because as investors lose faith in fiat currency, they sell treasuries to buy hard assets. That selling pushes treasury prices down and yields up. And as yields rise, the valuation models for stocks break down. Discounted cash flow models collapse. The stock market has to reprice, and the Fed is left with two choices, both of which are catastrophic, and both of which are massively bullish for silver. Choice one, print money. The Fed can restart quantitative easing. They can buy treasuries to suppress yields. They can save the stock market in the short term, but that destroys the currency. It validates the inflation concerns. It sends gold and silver vertical. It creates a hyperinflationary spiral where tangible assets become the only store of value. Choice two, do not print. The Fed can allow yields to rise. They can let the system purge bad debt. They can allow the stock market to crash. This avoids hyperinflation, but it guarantees a depression. And in a depression, confidence in the financial system evaporates. And when confidence evaporates, capital flees from promises to reality, from paper to metal, from stocks and bonds to gold and silver. There is no third option. The Fed is in checkmate. And every move they make from here accelerates the flight into precious metals. And just to make matters worse, there's now a criminal probe into the Federal Reserve chair. This isn't speculation. This is breaking news. Federal authorities have issued subpoenas. This is eroding confidence in the central bank at the worst possible moment. It's accelerating the loss of faith. It's accelerating the flight from financial assets to physical assets. The timing could not be worse for the establishment, and it could not be better for anyone holding silver. So where does this go from here? Let me give you the strategic framework. First, understand that not all silver exposure is created equal. If you're holding paper silver, if you're holding an ETF that promises to pay you in cash, if there's a market disruption, you are taking counterparty risk. You're trusting that the system will honor its promises at the exact moment when the system is breaking down. That is a bad bet. The safest way to own silver is physical coins and bars in your possession, or an allocated storage that you control. Yes, premiums are high right now. Yes, storage is a consideration. But you eliminate counterparty risk. You hold the actual asset that is at the center of this repricing event. If you cannot or will not hold physical metal, the next best option is PSLV, the Sprott Physical Silver Trust. It has transparent auditing. It has a redemption feature for large holders. It is tethered more closely to the physical market than other paper products. But avoid SLV, the iShares Silver Trust. It has a clause in its prospectus that allows for cash settlement if there's a market disruption. That means you could be forced to accept cash at the broken paper price while the physical metal trades at a massive premium. You miss the entire upside. Do not take that risk. Second, understand your exit strategy. And here's the key. Your exit strategy is not to accumulate more dollars. Dollars are the problem. Your exit strategy is to trade silver for other hard assets: land, income-producing real estate, a business, energy, infrastructure. The objective is to wait for the gold to silver ratio to compress. Wait for the silver to real estate ratio to shift dramatically in your favor. Today, it might take 5,000 ounces of silver to buy a house. At the peak of a precious metals mania, it might only take 500 ounces. That's the trade. Swapping one form of generational wealth for another, bypassing the currency system entirely. Never trade your silver back for fiat unless you have an immediate expense. The goal is to ride this wave all the way to the top and then rotate into productive assets that generate cash flow. That's how you build lasting wealth. Third, prepare for volatility. The road to $100 will not be smooth. It will be violent. We will see days where the price drops $5 in an hour. These are widowmaker wicks. They are designed to liquidate over-leveraged retail traders. They are designed to shake you out. If you are using leverage, if you're trading on margin, these moves can destroy you. But if you are holding physical metal or unleveraged positions, these dips are noise. They are temporary. They are gifts because the physical market will not follow the paper market down. When the paper price drops, premiums will expand to fill the gap. The all-in cost will stay high, and smart money will use those dips to accumulate more. Here's what you need to watch. The gold to silver ratio. This is your compass. Do not focus on the dollar price. Focus on how many ounces of silver it takes to buy 1 ounce of gold. Right now, we're at 54 to 1. In 1980, the ratio hit 15 to 1. In 2011, it hit 30 to 1. Until we see that ratio drop below 30, this bull market is young. We have massive room to run. The second thing to watch is the Shanghai spread. As long as Shanghai is trading at a premium to New York, the magnetic force pulling Western prices higher is still in effect. The moment that spread closes, the catch-up phase is over. But we're not there yet. We're not even close. The spread is widening, not narrowing. That tells you the buying pressure in the East is accelerating faster than the West can keep up. The third thing to watch is availability. We are approaching the unobtainium phase, the phase where you cannot buy silver at any price. As the industrial panic accelerates, major refiners will declare force majeure. They will implement allocation limits. They will stop selling to retail dealers to prioritize their industrial clients. Companies like Samsung and Tesla will get first priority. Retail investors will get cut off. When that happens, the buy button disappears from your favorite bullion website. The price on the screen becomes irrelevant because there is no inventory. If you are sitting on cash right now, waiting for a pullback, you're playing a dangerous game. You might be waiting for a dip in a market that has closed its doors. Let me be very clear about the timeline. We are in the acceleration phase. The move from $20 to $30 took months. The move from $70 to $85 took days. The next move from $85 to $100 could take hours. This is how parabolic moves work. They compress time, they accelerate, and the higher the price goes, the faster it moves. Because every new high creates more urgency, more fear of missing out, more forced buying from shorts who are trapped, more algorithmic momentum chasing. It feeds on itself. And once you enter that phase, trying to time the market becomes impossible. You either have your position or you don't. There's no in between. I want to address the people who are thinking about selling right now. You're looking at your account. You're seeing gains you've never seen before. You're thinking about taking profits. You're thinking about locking it in. I understand the temptation, but let me tell you what you're actually doing. You're selling the lifeboat to buy a ticket back onto the Titanic. You're trading a scarce, strategic, war-critical asset for a paper liability that is being printed into oblivion to fund the very crisis that is driving the asset price up. You're giving your position to the institutions at the exact moment when they are desperate to get in. Do not be the liquidity provider for BlackRock. Do not sell them your silver at $85 and then watch them ride it to $200. Make them pay. Make them pay the premium. They should have bought at $20 like we did. Now that they want it at $85, the price is going higher. The institutions are late. They are underweight. They are panicking. And when they come back to their desks after the holidays, they're going to realize they missed the breakout. They're going to realize they have zero exposure to the best performing asset of the year. And that is a fireable offense in the institutional world. Career risk is more powerful than greed. When the portfolio managers walk into their risk committees in January, the agenda will be simple. We need to hedge. We need silver now. And here's the problem. The silver market is microscopic. A single large pension fund allocating 0.5% of its portfolio to silver is a larger order than the entire daily liquidity of the COMEX. Imagine trying to force the water of Hoover Dam through a garden hose. That's what's about to happen. The hose will burst. The price will not go up. It will dislocate. It will gap. This is why I say the real move hasn't even started yet. What we saw over the last 72 hours was the dress rehearsal. It was the skeleton crew. It was junior traders and algorithms. The captains of capital are still on vacation. They are seeing these alerts on their phones. They are seeing silver at all-time highs. They're getting nervous. But they can't do anything until they get back to their desks. When they return, when they try to deploy billions of dollars into a market with only millions of dollars of daily liquidity, we will see price action that makes the last 3 days look calm. We will see gaps of $10, $20. We will see limit-up days where trading is halted. We will see a market that is completely overwhelmed by demand. The convergence of the technical breakout, the Shanghai arbitrage magnet, and the physical supply crisis is not random. It is a signal, a historic signal that the game has changed. The fundamentals are locked in. The bridge to the past is burning. There's no going back to $20 silver. The market forces at play are too powerful to be contained by the old paper regime. The era of cheap, suppressed metal is over. The future belongs to those who hold the physical reality, not the paper promise. The perfect alignment of these forces is creating the investment opportunity of a generation. But the window is closing. Every day that passes, more metal disappears from the market. Every day that passes, premiums rise. Every day that passes, availability shrinks. The opportunity to acquire physical silver at prices that will soon seem impossibly cheap is vanishing in real time. You have done the hard part. You recognized the setup before the crowd. You understood the fundamentals when the media was silent. You bought when it was boring. Now you just have to do the hardest thing of all. Hold. Do not let them shake you out. Do not let them steal your position with fake sell-offs and psychological warfare. You are holding the only asset that matters in a world that is losing its mind. The $100 wave is coming, and when it arrives, the landscape of the financial world will be changed forever. Silver will never be cheap again. The dollar will never buy what it used to. And the people who understood this moment, who positioned themselves on the right side of this trade, will be the ones who preserve and grow their wealth through the chaos that is coming. The era of paper price discovery is dead. The physical market has won, and the repricing has only just begun.